Warren Ingram, retirement people on the verge of retirement often worry about their income, but they're worrying about the wrong sort of thing, are they?
I think they should be worrying about their income and maybe a bit less about their capital is really the key, Bruce. I mean, I can't tell you how many times when you talk to people about retirement, they will say, I've got, I can't wait to get to 50 million or 10 million or whatever the number is. And then I'm loaded and I'll be absolutely fine. But actually, when you see people in retirement who are kind of living day to day and month to month as retirees, they focus a lot less on their capital and much more on what kind of income stream they can get from their capital. And so actually, the answer is we've got to figure out as we get closer and closer to that time when we want to retire, how much income can we generate, and don't worry too much about the extra zero or the on our capital balance sheets or our personal balance sheets, because actually that doesn't matter nearly as much as you think.
Okay, so talk to me about it then. How should we be looking at this differently? How should we be really getting the balance right?
I mean, to me, it starts with the key question, which is if I'm sitting with someone and they say to me, I've got, just any number, I've got 10 million rand. Am I going to be okay in retirement? I have absolutely no answer to that question. That's like saying, pink. If someone says, just completely arbitrary, what's more important to me is I'm going to ask them the first question, which is how much are your expenses? How much do you need on a monthly or yearly basis to actually fund your kind of preferred lifestyle, and realistic, I mean, if it is realistic for you to fly first class, great. If it's not, what's your realistic lifestyle? And that number is absolutely key. So, if you're going to spend, just for argument's sake, I've got to do the math simply for myself. But if, let's say, you spend 20,000 rand a month, at your kind of ideal financial freedom day or your retirement day, then get that to an annual number. So multiply that by 12. And that's the key. So you're going to spend sort of 240,000 rand a year over a normal kind of retirement year, and then multiply that by 25. And that's important because that's a sort of a sustainable amount that you can draw on your capital. And I mean, I know I'm kind of speaking math Greek to you now, but 25 is important because what that means is it's the same as drawing 4% a year from your capital. That's how we get to 25. So if you take your annual expenses and you divide it by 4%, that's the same as multiplying by 25.
And depending on how much you spend, of course, your pool of capital is either going to last those 25 years or not. And either you can draw at 4 or 5%, or you have to draw down at 2%. And it would, depending on what those expenses are. So expense is absolutely pivotal to this equation. There's no escaping it.
And I think exactly right. And so for someone like that, that sort of 4% rule multiplying by 25 gets them to a capital amount of 6 million rand. And that's a key number for them because it's determined by the expenses. So for them, all they need to know is, can they draw that income? Is it sustainable? And if it is, the 6 million number is great for them. But someone else might say, okay, so the chap next door can gets by on 6 million. I'm going to aim for 6 million and I'm fine. You're not fine if you're going to spend 30,000 a month, and therefore you need 360,000 rand a year. Your number is way different. It's going to be much higher. So aiming for an arbitrary number because someone said it on the radio or your neighbor said it next door, that's completely useless. You need to know, what are your expenses? How much do you need on a monthly or yearly basis to actually fund your preferred lifestyle? And that's the key. So if you're going to spend, just for argument's sake, I've got to do the math simply for myself. But if that your expenses and the way you live your life, around money, that determines everything at retirement. It's not some arbitrary calculator. And if you go on some kind of generic online calculator to say this is what you need, if you earn X every month, then this is what you'll need at retirement, that's also useless. What you earn is not nearly as important as what you spend.
So, and the other thing that we've got to factor into this equation is something that we thought was dead. We thought inflation was dead. Well, not we. I didn't think inflation was dead. I just knew it was gone on an extended holiday. But some people I know were telling me 5 years ago, oh, you don't need to worry about inflation anymore. Central banks have got this thing under control. Inflation is dead. Ha ha. Famous last words. Inflation has come back with a vengeance. And there's in no way in this current environment that your income is going to keep up with the price of inflation. And that's a real concern. And somehow you've got to factor that into the mix of this very difficult equation.
Exactly right. And what's interesting, talking to retirees in these circumstances where inflation is shooting up, what they are doing is they're actually simply adjusting their expenses. I'm saying simply as if it's an easy thing. It's not. It's very difficult to spend less. You're making real sacrifices at retirement. But what they are doing is they are making trade-off decisions. So they're saying, I'll cancel my TV subscription, or instead of buying a replacement car every 5 years, I'm gonna push it out to every 6 or every 7 years, and they're making almost real-time adjustment to their expenses because their cost of living has escalated so quickly. And important to note here that they're focusing on the things they can control. In other words, the expenses is something that they have some impact on. Obviously, they can't control inflation, but they can control to some extent how they spend. What they're not worrying about is a capital asset. They're not saying, okay, well, I'm going to sell that art collection now because I need an extra 3,000 a month. They're not doing that. They're actually focusing on the most important things to them, which is their expenses. And so circling back, the big amount, the big number, the lotto number that you think you're aiming for, don't worry about that. Try and keep your expenses as low as possible and control them. And then you might win the inflation war much, much more easily than someone who just ignores their expenses until it's far too late.
And if you don't like the ratio between your income and expenses and you haven't saved enough, just take some comfort from somebody called Lesego. Lesego tweeted 2 days ago. Lesego said, in traffic, I normally have coffee on my mind. I've often asked myself why nobody's selling coffee during traffic. And this morning, I could barely contain my excitement. I saw this man selling coffee in traffic and he poured mine. I asked for a picture. So Lesego takes a picture of a guy who has got an over-the-shoulder contraption. It looks like an apron and a bag and paper cups and one of those 2 or 3 liter pump pots, and is pumping coffee into a cup. And he's got a little cardboard sign that says coffee, $15, cookies, $5. And then you see the response today from the guy who does the coffee. Hello, guys. I'm the guy selling coffee on the R55. He says, he says to the person who posted, to Lesego who posted, he says, I owe you coffee. Thank you guys for the positive feedback. This is very touching. I'm on the R55 weekdays from 6:30 in the morning, coffee to car. And it's amazing, Warren Ingram, just, the way in which people are making a living and are surviving. Perhaps that's a side hustle. Maybe he's got a day job. I don't know. But certainly there are many, many innovative ways to up your income if your income isn't matching the expenses growth that you have. It's, it's never too late to make some kind of a plan to alleviate the pressures on yourself.
And I keep thinking about people that might be at the very early stages of retirement or very late stages of their career, and they're constantly, in my view, undervalue two things. One, they undervalue the time that they're going to have at their disposal, and they undervalue their life experience and potentially their career experience. And to me, we're all kind of running as hard as we can just to get by every single day, and especially families where both parents are working, which I think describes pretty much most families nowadays. the one thing they all run short of is time. And we see it with the explosion of these shopping services, where you can kind of order your online shopping and arrives in less than an hour. The kind of moving your food around, moving your kids around potentially. All of those things are about finding ways to get time. And if you're in that position where you've, early retirement and maybe, not enough income to cover your expenses, well, what you have is time. And if you can offer your time to people who don't have time, that's a fair exchange. People will pay quite a bit of money to get more time in their lives.
Warren Ingram is a personal financial advisor. He's a director at Galileo Capital. A question from Marcel Johannes this evening saying, I'm a couple of years into my journey to financial freedom. I'm saving money. I've built up an emergency fund. Tick. I've luckily never had too much debt. Tick. Now I have a lump sum that I would like to invest, and I am trying to decide between a passive fund or an active fund. I know a lot of active funds don't beat the passive funds after fees, but I like the idea of someone making smart decisions with my money. Are there any traits or characteristics you would look for in an active fund to increase my chances of choosing a good one? Lovely question, Marcel. That question to Warren in a moment.
The Money Show.
Personal Finance with Warren Ingram.
So can you make a smart choice to have an active fund manager manage your money? Somebody's got a better chance of beating the index than others, Warren Ingram. Is there a mechanism to do this? I've got a feeling I know the answer, but I'd like to hear yours.
For fear of sitting on the fence, I have always, since they've been available, been a big fan of index investing. What Marcel in his question calls passive investments, and I still am. I think they are very valuable. But I do, and I have also always thought that there is scope to choose a fund manager who can aim to give you either higher growth than what the index will give you over time, or match the growth, but potentially at somewhat less risk. And that might sound like a Goldilocks scenario where everything's exactly right, and sure, that is the case. So I would tend to blend those two. In other words, I would tend to have some index investments in my kind of personal portfolio, and I would certainly have an active manager. If you're going to choose an active manager, I think the important thing is firstly that you know exactly what you're buying when you buy an active manager. In other words, understand what the fees are. Are the fees very simply, very clearly explained to you? Are the fees low? Because what we know about active managers over time is that those that have low fees tend to perform very well. Those that have high fees tend to be right at the bottom of the rankings of performance measurement. So low fees is a big tick. That's one big thing you need to know. Transparency of the investment is I think equally important, and it needs to be something where if you read it, you have an idea of what the fund manager is trying to do, how they look at the investment world, and why they buy certain things, and potentially also what they don't buy, what they tend to avoid. And then very importantly for me is if you're going to have a blend, in other words, you're going to have some index investments in your portfolio, it's useless going to buy an active fund with a fund manager that says, I tend to be benchmark aware, and I'm going to buy slightly more shares than the index when I believe in a company, and slightly fewer shares than the index when I don't believe in a company, because all you're doing then is getting a really expensive index. So if you're going to buy an active manager, they need to have investments which look fundamentally different from the index. They need to be very active. They need to have very high conviction in the companies or investments that they're going to buy for you, and they need to be limited in number. It's pointless. For example, in South Africa, if you said, I want to buy a fund manager that invests in the stock market, don't buy a fund that has 200 shares, because what the fund manager has done is simply bought all the shares on the JSE. You're looking for something that owns 20 or 40 shares and very big allocations to each of those. So they need to be very active, very low fees. Try stay away from performance fees if at all possible, and simple, transparent, well articulated investment philosophy, and if possible, a long history of sticking to that investment philosophy in good times and in bad times. You don't really want a fund manager flip-flopping from one style to another style because what worked last week doesn't work this week, and I'll try something different next week. That's a huge danger sign for me.
So you can't just tell by the colour of their eyes or the glint in their smile. It's a lot more complicated than that.
Yep, and the quality of the of the marketing material and the TV ads and all that stuff that doesn't count. To me, I want some of these fund managers, the very best ones, are very prickly personalities. They're not great marketers. They potentially don't like people as much as they like spreadsheets and annual reports. And they're out there researching and not marketing and not talking. They're out there trying to find the best investments to buy. So there might not be people that you'd want to invite home for a lovely braai and stimulating conversation. But I found that the very best fund managers are often not the people that give the best talks and have that kind of give you that warm fuzzy feeling. That they're really analytical, really driven to research and kind of almost exclude everything else. And those are the ones you're looking for.
Wonderful. Let's wrap it up with a quick question on I picked a phrase, a word of the week. Cyclical stocks. Is there such a thing as a cycle anymore?
There is, and it's really timeless because lots of concern about the international, the developed world, let's say, going into recession if they keep pushing up interest rates. And so if the economy goes into recession, then the companies that have done well when the economy was booming will start to suffer because they tend to follow economic cycles. So if you think about things like airlines, car manufacturers, hotels, anything where you don't have to spend money on their product or their service to get by would typically be called cyclical shares. And so when people are feeling the pinch and they're worried about their economic future, they'll spend less or stop spending on discretionary expenditure, and that's always to the detriment of the cyclical stocks. And so definitely a big part of the investment world, and fund managers that specialize in growth shares, for example, often buy these cyclical stocks. And the opposite of that would be things that we can't stop spending on, for example, electricity or water and those kinds of more defensive shares. So yeah, definitely we're right in the middle of a cycle change now, Bruce, around the world and maybe in South Africa again.
Thank you. Warren Ingram, Director, Galileo Capital, also a personal financial advisor.